And welcome back to the Financially Simple Experience. I'm your host, Justin Goodbrand. Today, we're going to talk taxes. And before you go any further, you're probably like, brother, man, it's almost Christmas, dude. We want to talk about taxes? Yeah, it is December. December is the time of the year that we focus on taxes. As business planners and business advisors and financial advisors, we realize that once December 31st rolls past, so many of our tax planning capabilities reduce. So today I want to give you 20. That's right. It's the year 2020. I want to give you 20 different tax reducing strategies that you can use in your personal finances, in your business to help minimize your taxes. So we're going to go through these in like rapid speed. We're going to have a long article on financiallysimple.com. We'll put the link to that article in the show notes. But I want to go through 20 things that you can utilize this year to help minimize your taxes. So here we go. Let's start off. Number one, first thing you can do is you can make contributions to your pre-tax retirement accounts. Now, by the end of the year, you have to have your contributions in your 401ks. It's not the same with your IRAs, your SEPs, and a solo K even, but if you're in a 401k, by the end of the year, you need to get your contribution in. So for this year, 2020, you can put in $19,500 if you're under the age of 50, or if you're over the age of 50, you can do $25,500 for this calendar year, 2020. You may say, well, Justin, I don't have a 401k. I want to use a SEP. Well, if you want to use a SEP IRA, you can do 20% of your profits of your company. That's typically worked in the following year. So you're going to file your taxes in 2021 for this year. Typically, your accountant's going to give you the calculation. It's ballpark about 20% of your NOI of your company. That's how you fund it. And you can fund your SEP next year for this calendar year. Even though we're in 2021, when you file your taxes, you can still put money into your SEP. You say, well, I have a simple plan. Well, in a simple plan, you can do $13,500 this year if you're under the age of 50. So that's a pretty good catch up. You say, well, Justin, all I have is an IRA or a Roth. Well, this year we can do $6,000. $6,000 if we are under the age of 50. If we're over the age of 50, we can do $7,000. So right off the bat, we're going to say the very first strategy you can use is you can fund your retirement accounts. Number two, now's the time of the year to start looking at tax loss harvesting. Now, it's been a funky year this year with the way the market's moved up and down, but perhaps, just perhaps, you have some short-term losses. You can actually calculate and grab those losses and help you reduce your taxes by up to $3,000 this year. The calendar year. Now, you need to do that before 12/31. It's a strategy that we employ that we're already beginning to look at right now within our clients' portfolios. It's called tax loss harvesting. You can read more about this on the Financially Simple blog. Another thing you can do is you can work with tax bunching. Tax bunching is where you're trying to maximize your Schedule A deduction. Now, when the Tax Cuts and Jobs Act was passed, some people call it the Trump tax cuts, was passed back in 2017, it raised the standard deduction. By raising the standard deduction, it made a lot of people where they couldn't claim Schedule A deductions on their tax returns anymore. They just took the standard. Well, perhaps, just perhaps, you want to try to finagle your numbers to where you have a higher Schedule A. Now, what is on a Schedule A? On a Schedule A, you have your health deduction. That's for health expenses. Go on the very top of the Schedule A. Then you go into your taxes. Taxes include your sales tax or property taxes, or if you have a car tax, those type of things. Then you go into your interest that you pay for your mortgage, and then a couple of other miscellaneous deductions at the bottom. One of the things you can do is you may be able to bunch in your charitable deductions. Charitable deductions fall on Schedule A. And a lot of times people will say, well, look, I'm going to give, let's say, $10,000 to the church for 2020 and $10,000 for the church for 2021. You can actually pull 2021's contribution into this year, get $20,000 on your Schedule A, couple that with your interest deduction and your tax deduction, and you may be able to drive your Schedule A deduction above the standard deduction. So it's called bunching. You can read more about this on the blog. The fourth thing you can do is you can keep or purchase health insurance. That's right. According to the Affordable Care Act mandate, it was repealed in 2019. I get that, but you can owe a fee. You no longer owe a fee on your taxes, but there are some states that require you to carry insurance. So if you're in one of those states, you can purchase insurance or you can keep your insurance, and by doing so, you may be able to lower your state taxes. So that's one of those little caveats there on the state level. Now, one of my favorite things you can do is number 5, is you can utilize a health savings account. I love the health savings account. It is the only account, hear me, it is the only account that you can put money into it, get a deduction. It grows tax-free, depending on how you invest it, and then you can take your money out tax-free. Think about that. You never pay taxes on this money. In fact, it's like a triple tax savings thing here. The only account that does that. So a health savings account, number 5. Now, this year you can put in $7,100. I'm going from memory here. $7,100 on a married couple, or $3,550, if I remember right, on a single individual. I'm actually going to check that now that I'm saying that from my memory. Most of these podcasts I record from my memory. That may surprise you. That's right. I do a lot of this from my memory here, but I think it's $7,100 this year. It might be $7,000 this year and $3,500. But you nonetheless can do your health savings account. Number 6, you can have a flexible spending account. That's right. Maybe, just maybe, that your company, if your business is large enough, they may offer you an FSA, flexible spending account, or they may even have an HRA, health reimbursement account. But a flexible spending account allows you to put money away very similar to that of an HSA. So if you have a large enough company, you may want to set a FSA up for your employees. Now, number 7, this seems obvious, but it doesn't always count. You want to track your medical expenses. You want to go back through your budget and segregate those things, or segment those things which were health related. Why? Because it can actually help you on your Schedule A. Okay, so you want to keep track of all your health-related expenses. These can be insurance premiums. These can be medicines that you buy, doctor's visits, surgeries, you name it. There's a lot of different things. Talk to your tax advisor, but if you don't know exactly what to do, but you want to separate out and track your medical expenses, it just could help you this year. Number 8 is you want to track your budget in general. You want to track your budget. Now you say, Justin, how's that help me on taxes? So many people walk into their CPA's office. I know, because I know a ton of CPAs. And here's their number one gripe. Justin, it's tax time. I'm meeting with my clients. They bring in this bag of crap. They bring in this junk to me, and I have no idea. And they want me to just solve their tax problems. If we organize our numbers in some sort of like a software package that'll help us manage and keep track of our expenses, then it helps our tax preparers look for the deductions, look for various ways that they can save us on taxes. But it's not going to happen unless you track your budget throughout the year. That's my number 8 advice. Number 9 is you may want to make some adjustments to your income. It's not uncommon that we'll see this time of year where we'll reallocate the ownership of a company in order to help with taxes. We may move somebody from an owner's draw to a W-2. We may reduce a W-2 or increase a W-2 income, depending on what type of entity we're dealing with. So you may want to make adjustments to your income. This is where planning comes into play. Number 10, we're at number 10. You want to utilize every business deduction possible. You think, Justin, that goes without saying. That's true, except for most CPAs know how to save taxes. That's their job. But once December 31st rolls past, then you help reduce the number of strategies they can do. So now's the time when you want to be proactive in trying to maximize the deductibility that's possible for you in this calendar year 2020 especially.
If we had learned anything from recent events, it would be the importance of having a personal financial plan to weather any crisis life throws at us. Heritage Investors helps small business owners to reach their financial goals with holistic wealth management services. Learn how by visiting heritageinvestor.com today.
Number 11, you may, depending on the state you're in, you may want to contribute to a 529 plan. As I mentioned, number 4, some states require health insurance. Many times those states will allow other tax incentives like a 529 plan contribution. So if you have children that plan on going to college, or grandchildren that maybe go to college, and you're in one of these states that offer a deduction, for example, Minnesota, that you could put into your for your contribution put into your 529 plan, it's a good idea to consider that. Number 12, take advantage of the lifetime learning credit. That's right. You can get up to $2,000 in a tax credit just by using the lifetime learning credit. It's a huge, huge credit. Notice I said credit, not a deduction. Lifetime earning credit. Number 13. Now, this may not be you, but you could have a baby. We have several clients who are young that are having babies. And if you have a child in this calendar year, let's say even a Christmas baby, that's going to help you with an additional $2,000 tax credit for each qualifying dependent under the age of 17. And again, that's part of the Tax Cuts and Jobs Act. That's the Trump tax cuts, which gave us $2,000 if we have children, qualified children under the age of 17. Number 14, you could give money to charity. That's right. You could go out and you can give money to tithe. Let's say you give tithe to your church. That's going to go on Schedule A. You could give money to a school, a Christian school, as part of philanthropic desire. We are actually helping we call it Compassion Closet here in our town. We're giving some money and some gifts to a organization, a 501c3, that helps children who get placed in foster care. Help them have a Christmas. That's a big deal to me and my family, my wife especially, is to help these kids who are in foster cares have a Christmas. So many of them don't. You can make a donation now between now and the end of the year that'll help somebody brighten their day, help a charity somewhere, and that could create a tax deduction for you. 15, you could buy a house. You could buy a house. Now, depending on the type of house you buy, if you buy a mortgage, if you buy an investment property, you could actually create deductible expenses or depreciation depending on the type of house you buy. So you may want to go out and buy a house, like a rental property, et cetera, between now and year end, depending on where you're at in the country. I will say that the real estate bubble is abounding around us. A lot of bubbles. UBS does a national real estate bubble index, and you wouldn't believe the number of places around our country that are hitting all-time highs in the housing market. But nonetheless, you could buy a house. Now, here's where it gets kind of crazy. You can deduct the state and local taxes on your income tax up to $10,000. And so if you have a home, you can drive that almost up to $10,000 depending on the size of the home, which will help you in your taxes. Number 16, you can have your property reassessed. That's right. You can call your assessor's office and say, hey, I don't think you have my property assessed right. And you may be able to reduce your property taxes by having your property assessed. You can go in and make your house more energy efficient. That's number 17. You could put in a geothermal heat pump. You could get a higher quality HVAC system. You could do solar panels, maybe more efficient water heaters. Check your regulations, but there is an energy tax credit available up to the year 2021 for up to 30% of the cost of the installation. So there's a tax credit. Notice I said credit, not a deduction. Number 18, I'm actually considering doing this myself. You could buy a car. You could buy a piece of equipment, whatever it is, but you could buy something and perhaps you could go through a bonus depreciation. So certain vehicles are giving in tax credits this year. There's a list of those that you can gain in the Internal Revenue Code, but you could go out and buy a car that qualifies for a tax credit. Number 19, and we're seeing a lot of this right now, you can move to a lower income tax state. In Tennessee, we actually do not have income taxes. Now, I got to warn you, Nashville's getting a lot of people from California. In fact, so much so that we're saying, don't California my Tennessee. We do not like California politics in Tennessee. So if you want to come to Tennessee, come on. But there's a reason why we have 0 state income taxes. We do not need the politics that arise in other parts of the world, of our country. What we're seeing, though, surprisingly, is we're seeing states like New York, like California, like New Jersey, like New Hampshire. People are moving from these high income tax states to other states throughout our country. And that's not a bad way that you could end up reducing your income tax. So here we are for number 20. The PPP loan this year is going to give us some heartburn. If you get it forgiven, there are some taxes that we will owe on the PPP money. So one of the ways that you can offset it, we call it the gift that keeps on giving, is you could use a donor advised fund. That's right. On a donor advised fund, you actually name a charity. You place a contribution into this fund. You can invest it. Well, you don't have to give it to the charity, but you can invest it. And by doing so, you get a Schedule A deduction, which actually goes back and helps bolster our Schedule A even further. Then once the money is moved out of the fund to the charity, any additional gains on that creates an additional deduction. So I'm going to ultra simplify it. We actually have a whole article on the blog about donor advised funds. So I'm just simplifying it there, but you could utilize a donor advised fund to help you reduce your taxes even further this year. Now, look, I'm not giving tax advice. I'm a tax planner. I work as a CFP. I work in the area of tax planning, but I work alongside CPAs and tax attorneys on a regular basis. Now is the time more than ever for you to meet with your tax advisors, plural. We all think differently. I'm having multiple meetings right now with clients who the CPA or the tax attorney is meeting with us, and we are cranking through various thoughts and challenging each other, trying to figure out how to minimize our clients' taxes as best as possible. Now's the time. It is December. It is the busiest time of the year for tax planning. You ever thought I was going to say Christmas? No, it's busy time of the year for tax planning. I've just given you 20 ideas, 20 ways that you can reduce your taxes. Only you can control it. If you don't know how to do it, hey, reach out to us. This is what we do day in, day out. Check us out at financiallysimple.com. And until next time, y'all make it a great day. This tip is for informational purposes only. Please speak with a competent financial advisor regarding your specific needs. Justin Goodbread is a registered investment advisor with Heritage Investors. Visit heritageinvestor.com, financiallysimple.com for additional information.